Okay, so we're taking a deep dive into Warren Buffett's letters to Berkshire Hathaway shareholders. We're going way back to 1997. And we're going to go all the way through to his latest letter in 2023. And hopefully, along the way, we can glean some timeless wisdom about investing in business.
Sounds good.
So in 1997, right off the bat, Buffett really wants to make this distinction between book value and intrinsic value. He includes this table in his letter comparing per-share investments to per-share earnings.
Oh, interesting.
From Berkshire's operating businesses. And he basically wants to emphasize that those operating businesses have actually contributed a lot to Berkshire's success. It's not just the investment portfolio. He even points out that both the per-share book value and the per-share earnings from these operating businesses have grown at a pretty remarkable pace over the decades. And he attributes this success to the incredible team he's built at Berkshire, particularly his longtime partner, Charlie Munger, who unfortunately passed away earlier this year. And he really highlights how they've built this culture where people are motivated by more than just money. I think this is something that's really important for any business leader to keep in mind. It's not just about the bottom line. It's about creating an environment where people feel valued, respected, and motivated to do their best work.
Yeah, absolutely.
But here's the challenge that Buffett faced back in '97. And it's a challenge that many investors face today, which is finding those golden investment opportunities when prices are really high.
Right.
He talks about how this actually makes his job a lot harder because he's very disciplined, about not overpaying for assets.
Sure.
And this is where he introduces this really interesting analogy of Ted Williams at bat.
Oh, I like this one.
So for those who aren't familiar with Ted Williams.
Yeah, give us a little background.
He was this legendary baseball player, considered one of the greatest hitters of all time.
Yeah.
And he was known for his incredibly disciplined approach to hitting.
Okay.
He divided the strike zone into 77 baseball-sized cells.
Wow, that's pretty precise.
And he would only swing at pitches that were in his sweet spot, the cells where he knew he had the highest chance of getting a hit. And this approach, even though it meant he took a lot of walks, led to an incredibly high batting average. And Buffett sees a parallel here with investing.
I see where he's going with this.
He argues that, just like Ted Williams waiting for that perfect pitch, investors should patiently wait for the right opportunities, even if it means missing out on some smaller gains along the way. And he says that he'd rather hold cash or short-term investments than just jump into something mediocre because it's available.
Right. It's about quality over quantity.
Exactly. And he even admits that these waiting periods aren't always fun, but they're necessary.
Sure. Sometimes the best action is inaction.
Exactly. And he acknowledges that sometimes when that perfect pitch isn't there, he ventures into what he calls the unconventional.
Oh, interesting. What does that look like?
So back in '97, he actually had positions in oil derivatives, silver, and even long-term zero-coupon U.S. Treasury obligations. Now, these are the typical investments you'd associate with him, but he was very upfront about the risks and willing to make these calculated bets when he saw the odds in his favor.
So he's not afraid to deviate from his usual playbook if he sees a good opportunity.
Exactly. And then he poses this thought-provoking question about market fluctuations.
Okay.
He asks us to imagine someone who's going to be buying hamburgers their whole life.
Okay.
And he asks, would they want beef prices to be higher or lower?
Lower, of course.
Naturally, lower prices would be better because they're going to be buying a lot of hamburgers over their lifetime.
Makes sense.
And he applies this same logic to the stock market.
Okay, I see where he's going with this.
He's saying that if you're a net saver, meaning you're going to be buying more stocks over time, a lower market is actually advantageous.
That's a really interesting perspective.
It is. And he says it's because it lets you accumulate more shares of great companies at a bargain. So it challenges that typical fear surrounding market dips.
Yeah, most people see a falling market as a bad thing.
Right. But he's flipping the script
and
saying, hey, if you're in it for the long haul, this could actually be a really good thing.
It's about shifting your perspective.
Exactly. And he really drives this point home by emphasizing that for long-term investors like you, a falling market isn't something to dread. It's an opportunity to snag more of those wonderful businesses at a discount.
Makes sense.
And he even points out how a falling market benefits Berkshire itself.
Oh, how so?
Well, the companies that Berkshire has invested in can repurchase their own shares at lower prices, which increases Berkshire's ownership without them having to spend an extra dime.
That's smart.
Okay, let's move on to insurance, which is clearly a passion for Buffett. He dives into this concept of float, which might sound a little intimidating, but it's actually pretty straightforward.
Break it down for us.
So float is essentially money that an insurance company holds,
Yeah.
but doesn't actually own.
Okay.
And this happens because there's a lag between when they receive premiums from policyholders and when they have to pay out claims.
Right, so they have this pool of money they can use in the meantime.
Exactly, and that's the key. Insurers can invest that float and potentially make a profit on it. But he cautions that figuring out the true cost of float is tricky.
Why is that?
Well, because predicting future losses involves a lot of unknowns. You're dealing with all sorts of unpredictable events, from natural disasters to car accidents to lawsuits.
Sure, it's inherently risky.
Exactly, and he points out that historically Berkshire has had a very low cost of float, which has been a huge factor in their overall success.
So they've been really good at managing that risk.
Exactly, and then he talks about this specialized area where Berkshire really excels, which is super cat insurance.
Super cat, what is that?
So super cat stands for super catastrophe. And this type of insurance covers other insurance and reinsurance companies against losses from those really major catastrophes, like hurricanes, earthquakes, things like that.
Okay, so it's like insurance for insurance companies.
Exactly. And because Berkshire has such a strong financial standing, they're often the go-to for this type of insurance.
But there's a catch.
Well, while it can bring in huge profits most years, it's also guaranteed to face these colossal losses. When those big catastrophes actually hit, he compares it to rolling a 12 with dice.
Okay.
The odds are slim, but it's bound to happen eventually.
So it's a high-risk, high-reward kind of game.
Exactly. And when those big losses do hit, the impact can be substantial. And he even criticizes the influx of what he calls investor money into catastrophe bonds.
Okay.
He argues that these instruments are often mispriced and carry a lot of risk, especially for those who might not fully understand them. And he worries that promoters can downplay the risks because there's limited data on these rare events. So it's harder to accurately assess the true probability of a major catastrophe.
It's like trying to predict the unpredictable.
Exactly. But despite these challenges, he wraps up this section by praising Ajit Jain, who heads up this segment at Berkshire. He credits Jain's underwriting discipline, his imagination, and his knack for finding those good opportunities as key reasons for their success in this really unpredictable market.
So it sounds like they have a real pro at the helm.
Exactly. Now let's talk about GEICO, which Buffett is clearly a big fan of. He highlights their impressive growth in voluntary auto policies and their strong underwriting profitability. He gives props to Tony Nicely, who's GEICO's CEO, for creating this great culture of vision, energy, and, well, enthusiasm.
Sounds like a fun place to work.
He then explains how GEICO's compensation structure is set up to keep managers and owners on the same page. So bonuses are tied to things like policy growth and the profitability of their seasoned business, not to stock price swings, which he believes are largely out of management's control.
So it's all about rewarding performance, not just riding the market's waves.
Exactly, and it's about aligning incentives, so everyone is working towards the same goal.
Makes sense.
However, Buffett acknowledges that the good times in the auto insurance industry might not last forever.
Why is that?
Well, he expects competition to heat up, which could squeeze margins. But he sees this as a good thing, believing that a tougher market actually benefits low-cost operators like GEICO.
So it weeds out the weaker players.
Exactly, and he's optimistic about GEICO's future. He predicts significant growth, especially considering they only have about 3% of the market share right now.
That's a lot of room to grow.
It is. And then he shares this kind of heartwarming story about Lorimer Davidson, who patiently explained the ins and outs of insurance to him back in 1951.
Wow, that's going way back.
It is. He was just a young, uninvited visitor to GEICO's headquarters back then. But Davidson took the time to educate him about the industry. And Buffett credits Davidson's generosity and wisdom for his understanding of insurance, which has obviously been instrumental to Berkshire's success.
That's a great story.
And he also talks about Berkshire's other primary insurance operations, praising their strong performance and the impressive track records of their managers. He points out that their 15% aggregate underwriting profit is significantly higher than the industry average.
That's impressive.
And he reminds us that this success has been achieved while sending 100% of their earnings to Berkshire to fund their growth.
So they're not holding anything back.
Exactly, and this leads to a really interesting point he makes about reported earnings. He argues that they can be misleading, especially at Berkshire, because the earnings in their financial statements only include the dividends they receive from investments, which often represents just a small portion of the actual earnings tied to their ownership stake.
Okay, so it doesn't tell the whole story.
Exactly. And he actually prefers leaving those undistributed earnings with the companies they've invested in
Why is that?
because he believes that those companies often have opportunities to reinvest those profits at really high rates of return, which creates more value for Berkshire in the long run.
So it's about that long-term compounding effect again.
Exactly. And to paint a more accurate picture, he introduces this concept of look-through earnings.
Okay, what's that?
So this metric takes into account Berkshire's share of the retained earnings of their major investees, adjusted for a hypothetical tax if those earnings were actually paid out. So it gives a better sense of the true economic progress, not just what's being reported on the income statement.
It's like looking beyond the surface level.
Exactly. Now let's talk about acquisitions. Berkshire acquired two companies in 1997, Star Furniture and International Dairy Queen. And Buffett emphasizes that both of these fit Berkshire's strict criteria. They're understandable businesses with excellent economics and run by outstanding people. He actually tells this really interesting story about how the Star Furniture acquisition happened. That highlights the importance of reputation and trust in Berkshire's deals.
Oh, tell me more about that.
So he first learned about Star Furniture from the Blumkin family, whom he'd partnered with years earlier, when he acquired Nebraska Furniture Mart. Then, years later, after acquiring R.C. Willey, based on a recommendation from that company's CEO, Bill Child, the name Star Furniture came up again, this time from Child himself.
So it was like a recurring recommendation.
Exactly. And it really reinforced Buffett's belief in the power of trusted referrals.
Makes sense.
So when the chance to acquire Star came up, he acted fast. He struck a deal with Melvin Wolf, the controlling shareholder and CEO, in a single 2-hour meeting.
Wow, that's quick.
It is, and it shows how much he values trust. He didn't feel the need to dig into the fine print of leases, contracts, or anything else, because he trusted Wolf implicitly.
So it was a handshake deal, essentially.
Pretty much. And then to further illustrate Wolf's character, Buffett shares this anecdote about Wolf and his sister, Shirley Tooman, who had taken over the business back in 1962. So when they announced the sale to their employees, they also revealed that they would be making these big special payments to everyone. And get this, they used their own proceeds from the sale, not Berkshire's.
Wow, that's incredible.
It is, and this act of generosity really impressed Buffett and solidified his belief in partnering with individuals who share his values. Because for him, it's not just about the bottom line, it's about doing the right thing.
Absolutely.
He then gives some background on International Dairy Queen, outlining its history, and turnaround under John Moody and Rudy Luther, and how Berkshire came to acquire it. He highlights their franchise model, their international presence, and being Buffett, he confesses his own fondness for their products. Then he gets into his personal preferences when it comes to acquisitions, and he reveals that he prefers using cash over Berkshire stock. He admits that his stock-for-stock mergers have actually cost Berkshire shareholders money over time.
Interesting. Why is that?
Well, he explains that it wasn't because he was misled or that those companies underperformed. It's because Berkshire already owns such a remarkable collection of businesses that trading a piece of them for something new rarely makes sense.
So it's like diluting their already strong hand.
Exactly. He compares it to a baseball team, trading a .380 hitter for a .350 hitter. Even though that acquisition on its own might seem beneficial, it weakens the overall team.
Right. I see the analogy.
In contrast, he says their cash acquisitions have been incredible. Companies like National Indemnity, See's Candies, Buffalo News, Scott Fetzer, and GEICO have all done exceptionally well under Berkshire. But he's also honest about the challenges of finding acquisitions that can truly add to Berkshire's already impressive portfolio. He jokingly compares it to Camelot's Mordred, who was destined to marry well, because everyone was above him.
That's a funny way to put it.
It is. And he assures shareholders that he and Charlie Munger will be very picky when it comes to issuing shares for future acquisitions. He also gets into the complexities of merging with public companies. He points out that paying a premium only makes sense if Berkshire's stock is overvalued compared to the company they're acquiring, or if the combined entity can generate significantly higher earnings than the two could independently. And since Berkshire's stock has rarely been overvalued, that first scenario is unlikely. Plus, he says those genuine synergy gains are often hard to come by, especially since Berkshire prefers to let their acquired companies operate pretty much as they did before.
So they're not looking to shake things up too much.
Exactly. And he's also critical of the common practice of stock options in compensation packages, saying it distorts earnings by hiding the true cost of paying people.
right?
So when Berkshire acquires a company using options, they swap that option plan with a cash compensation system of equal value. This brings the true cost into the open, and it gets charged against earnings.
This is about transparency.
Exactly, and he argues that this same logic applies to all acquisitions, not just Berkshire's. Paying a premium doesn't make sense unless there's a clear reason, based on valuation or proven synergy gains.
So it's not just about getting bigger, it's about getting better.
Right, and he even cautions that CEOs who are really excited about a particular acquisition can easily find people who will back them up, regardless of how bad the deal might be.
Oh, that's interesting.
So it's a reminder that while some mergers do achieve great things, many others fall flat, leaving the buyer with a big bill for nothing.
So due diligence is key.
Okay, now let's switch gears to Berkshire's common stock investments. So he includes a table in his letter showing their major holdings as of December 31st, 1997. And the ones exceeding $750 million are specifically listed. And you'll see some familiar names here: American Express, Coca-Cola, Disney, Freddie Mac, Gillette, Travelers Group, Washington Post, and Wells Fargo.
So a lot of blue chip companies.
Exactly. It reflects Berkshire's preference for established, well-known businesses. He mentions they sold about 5% of their portfolio that year, mostly reducing smaller positions and trimming some of their larger ones. And he says some of those sales were to adjust their bond stock ratio based on how they saw the market.
So they're actively managing their asset allocation.
Exactly. But it's important to note that those investment positions sometimes reflect decisions made by Lou Simpson, who independently manages a big equity portfolio for GEICO. And his moves occasionally differ from Buffett's.
So it's not always a unified front.
Right. And then he talks about their view of the stock market. And he reiterates that he and Charlie Munger aren't trying to predict market moves, but they do assess its overall valuation. And he recalls their assessment from the previous year's annual meeting, when the Dow was at 7,071, and long-term Treasury yields were at 6.89%.
Okay.
And at that time, they didn't think the market was overvalued if interest rates stayed put or went down, and if American businesses continued to achieve the same high returns on equity.
That they had been. So they had certain conditions in mind.
Right. And by 1997, interest rates had fallen, and returns on equity were still strong, suggesting the market wasn't crazily overvalued by those measures. However, Buffett cautions that returns on equity aren't guaranteed to stay at those levels.
Right.
And he expresses concern that the margin of safety, emphasized by Ben Graham, has eroded because prices have gone up.
So that cushion of protection is getting smaller.
Exactly. And he contrasts the current cheery consensus in the market with the skepticism from the summer of 1979, when he'd written a Forbes article arguing that investors should welcome pessimism.
Oh, interesting.
Yeah, he says because pessimism dries down prices, creating those attractive opportunities.
So it's about seeing the silver lining in the dark clouds.
Exactly. And he suggests that while today's market might not be blatantly overvalued, that reduced margin of safety warrants caution,
Sure.
especially for those looking for solid long-term investments.
So proceed with a bit more care.
Exactly. Then he talks about Coca-Cola, which was Berkshire's largest holding at the time. And he acknowledges Coke's market dominance, but expresses sadness over the recent passing of Roberto Goizueta, the CEO who led the company's impressive performance since 1981. He speaks highly of Goizueta's vision, his focus on shareholder value, and his drive to achieve goals. He even shares a personal anecdote about a handwritten note from Goizueta. That shows his dedication.
That's a nice touch.
And he praises Goizueta for making sure the leadership transition would be smooth by preparing Doug Ivester to take over. And he expresses confidence that Coke will continue its strong performance under Ivester's leadership.
So it's about having the right people in place.
Exactly. Next, he turns to Berkshire's investments in convertible preferred stocks. He gives an update on the 5 preferreds they bought between 1987 and 1991, highlighting their significant appreciation in value. He mentions the profitable conversion of their Gillette and First Empire State holdings into common stock, and the turnaround of their previously troubled investments in US Air and Salomon.
So they've had some wins and some losses.
Right, but he focuses on the wins here. And he expresses gratitude to Derek Mongan and Bob Denham for their work in saving Salomon from near collapse after the 1991 scandal, and making it an attractive acquisition target for Travelers Group.
So they turned a disaster into an opportunity.
Exactly. And then he talks about his admiration for Stephen Wolf, the CEO who orchestrated the incredible turnaround of U.S. Airways, a company where Buffett had actually made some unsuccessful investment decisions before.
Oh, interesting.
Yeah, he humorously recounts how he tried to unload Berkshire's U.S. Airways holdings at a loss, only to watch the stock price skyrocket after Wolf took over.
So he missed out on a big gain.
He did, but it's a good reminder that even the most experienced investors can make mistakes.
Absolutely.
And he credits Wolf's leadership for rescuing what seemed like a lost cause.
So it's about recognizing talent and giving credit where credit is due.
Exactly. He then describes this chance encounter with Frank Olson, the CEO of Hertz, while playing golf in Maine. And during that game, Olson, who knew the credit card industry inside and out, convinced Buffett of the strength of American Express's corporate card business.
Okay.
And this conversation led him to reverse his decision to sell Berkshire's Amex shares after they converted their perks. And he attributes his decision to hold on to those shares, which have since made a lot of money, to a mix of luck and skill. But he jokes that luck probably played a bigger part.
So sometimes it's just about being in the right place at the right time.
It seems so. Then he gets into a more practical issue, the rising costs and logistical challenges of sending quarterly reports to shareholders, especially those holding shares in street name, which basically means their shares are held by a brokerage firm, rather than directly by them. And he notes that Berkshire had started publishing their quarterly and annual communications online, giving shareholders another way to get that information. But he knows that some shareholders, especially those less comfortable with technology, still prefer those printed copies. So he asks for their feedback on whether they should keep printing and mailing quarterly reports, or if they should only send printed versions to those who specifically request them.
So he's really considerate of his shareholders' needs.
He is, and he encourages those shareholders who are comfortable with computers to check out Berkshire's website, which has tons of information about the company, including all their annual letters going back to 1977, plus links to the websites of many Berkshire subsidiaries.
Sounds like a good resource.
Then he explains why they post quarterly information to the SEC and their website at the same time. They want to make sure everyone has access to this important information simultaneously, whether they're direct shareholders or hold shares in street name.
So it's about fairness and transparency.
Exactly. Now let's talk about Berkshire's Shareholder Designated Contributions Program.
Okay, this is a really cool program where shareholders can direct a portion of Berkshire's charitable giving.
Oh, that's interesting.
Yeah, so he reveals that in 1997, 97.7% of eligible shares participated, leading to $15.4 million being distributed to 3,830 charities.
Wow, that's amazing.
It is, and he emphasizes the program's cumulative impact over its 17-year history, with Berkshire having contributed a total of $113.1 million based on shareholder instructions.
So they're really empowering their shareholders to make a difference.
Exactly. And he also mentions the charitable activities of Berkshire's subsidiaries, which usually follow the giving patterns in place before they were acquired. However, he regrets that some shareholders miss out on this program due to administrative things like not having their shares registered in their name by the record date or not returning the designation form on time. So he stresses how important it is to follow those rules to make sure it's fair for all shareholders. And he urges those who want to participate in the future to double-check their registration and send that form back promptly.
Finally, he talks about the upcoming annual meeting, scheduled for May 2, 3, or 4, 1998. The main event is on Monday, May 4th, at Excerpts Coliseum in Omaha. He's happy with the venue, which comfortably fit a large crowd the year before, and expects to handle even more attendees in 1998. So he encourages shareholders to arrive early, as the doors open at 7 a.m. And he highlights the day's planned activities, including a new movie produced by Mark Hamburg, Berkshire's CFO, Q&A with him and Charlie Munger, and of course the Berkshire product sales.
The Berkshire product sales?
Yeah, he actually shares anecdotes about the record-breaking sales of See's Candies, Dexter Shoes, World Book Publications, and Quicket Knives. At the previous meeting...
Because it's a real event.
It is, and he even teases a new line of Berkshire apparel. You can really sense his excitement about the event and how much he enjoys connecting with shareholders.
Sounds like a fun time.
He also encourages shareholders to visit the GEICO to see if they can save money on car insurance. He mentions that about 40% of those who inquire find out they can save by switching, and he reminds everyone about the special discount of up to 8% that GEICO offers to Berkshire shareholders in 38 states, with plans to expand to other states as they get approval.
Nice perk.
And he outlines all the logistical details for the meeting, urging attendees to book their travel and accommodations soon. He highlights transportation to and from the venue, plus options to Nebraska Furniture Mart, Borsheims, and the airport.
So he's got everything covered.
He does. He even gives details about Nebraska Furniture Mart, which is located about a mile from the Coliseum, and encourages shareholders to take advantage of a special discount offered to them during the meeting weekend. He also invites shareholders to visit Borsheims, which will be open especially for them on Sunday, May 3rd. He encourages those planning to visit on Saturday or Monday to identify themselves as Berkshire owners, to get a warm welcome from Susan Jacques, the CEO.
Sounds like a VIP experience.
Then he mentions a treat for bridge players, with legendary player Bob Hammond challenging anyone, at a table set up in the mall outside Borsheims.
Okay.
And he concludes by inviting shareholders to join him at Gorat's, his favorite steakhouse, which opens one Sunday a year, exclusively for Berkshire shareholders, the night before the annual meeting.
That's pretty cool.
He even jokes about the previous year's overwhelming demand, which led to the restaurant taking 1,100 reservations, despite only having 235 seats.
Wow.
And he urges those who make reservations but can't attend to cancel promptly out of respect for the restaurant.
Makes sense.
And with that, he wraps up his 1997 letter, giving us this glimpse into his investment philosophy, his approach to acquisitions, his appreciation for his management team, and his commitment to clear communication with Berkshire's owners.
So a lot to unpack there.
Definitely, and we're just getting started. We still have to dive into his later letters and see how his thinking has evolved over time.
I'm looking forward to it.
So let's fast forward to 2023, and we'll pick up where we left off.
Sounds
So Buffett starts his 2023 letter with a tribute to his late partner, Charlie Munger, who, as I mentioned, passed away just before his 100th birthday. And he credits Munger as the architect of Berkshire Hathaway, acknowledging his immense influence on the company's evolution and success.
So he was more than just a business partner.
Oh, absolutely. He recalls their first meeting in 1959 and Munger's initial skepticism about his decision to take control of Berkshire, which back then was a struggling textile mill.
Oh, wow.
He then shares Munger's crucial advice from 1965, urging him to shift his focus from fair businesses at wonderful prices to acquiring wonderful businesses at fair prices.
Oh, that's a big shift.
It was. It marked a change from the teachings of Buffett's mentor, Ben Graham,
Right?
and it really shaped Berkshire's path to what it is today.
So it was a pivotal moment.
Absolutely. And Buffett admits he didn't always perfectly follow Munger's advice, but he credits Munger with repeatedly steering him back on course whenever those old habits resurfaced. And he expresses profound gratitude for Munger's partnership and guidance, recognizing that they both ended up far better off than the goal they could have imagined because of their collaboration.
It sounds like a true partnership.
It was. He emphasizes that while he might be the public face of Berkshire, it was Munger who designed its unique structure and ensured its enduring success.
So he's really giving credit where credit is due.
Exactly. He compares their roles to those involved in constructing great buildings. While the architect's vision endures, the contributions of the construction workers are often forgotten. And he suggests that Berkshire has become a great company. And while he might have served as the general contractor, overseeing the daily construction, it's Munger who deserves the credit for the blueprint.
That's a great analogy.
He ends his tribute by expressing admiration for Munger's selflessness in allowing him to take the bows and receive the accolades, despite his instrumental role in shaping Berkshire's path.
Sounds like a true gentleman.
He was. Then Buffett moves on to the challenge of writing his annual letter, acknowledging the difficulty of addressing such a diverse group of shareholders, now over 3 million accounts.
Wow, that's a lot of people.
It is. And he states that he and Munger shared the same view of their responsibility to Berkshire shareholders, believing in open and honest communication.
Transparency is key.
Absolutely. He emphasizes that Berkshire seeks a specific type of investor, one who trusts the company with their savings for the long haul, without expecting those quick profits or frequent trading.
So they're looking for patient capital.
Exactly. And he contrasts this patient, long-term perspective with those who treat the market like a casino, constantly seeking short-term gains and chasing after the latest hot stocks.
It's a different mindset.
It is. And he reveals that Berkshire has been fortunate to attract a large number of these lifetime shareholders and their heirs, and he values them immensely and feels they deserve a candid account of the company's performance, both good and bad, directly from him, the CEO.
So he's accountable to them.
Absolutely. Then he introduces this really helpful mental model he uses when writing his letters, his sister, Bertie.
Oh, interesting.
Yeah, he describes her as smart, wise, and challenging, but always respectful. And Bertie, like many Berkshire shareholders, has a significant portion of her savings invested in the company and has been a long-term owner for decades.
So she's a good representation of the typical Berkshire shareholder.
Exactly. And he sees his job as anticipating Bertie's questions and providing honest answers. He recognizes that she represents a large portion of Berkshire's shareholders, someone who understands basic financial concepts, but isn't a CPA, follows business news, but doesn't claim to be an expert, and possesses a healthy dose of skepticism towards those financial experts.
Right, she's not easily swayed by hype.
Exactly. He describes Bertie as sensible and astute, someone who understands the power of incentives, the flaws in human nature, and the importance of figuring out who's trustworthy and who's trying to sell you something.
Those are valuable qualities.
They are. And he concludes his introduction to Bertie by posing the question that guides his letter. What would interest her this year?
So he's writing with her in mind.
Exactly. With that, he dives into the financial performance of Berkshire. He acknowledges that the official annual report, all 124 pages of it, is packed with information, some vital and some less so. And he anticipates that many investors and financial reporters will zero in on the bottom line net earnings figure, which swung wildly between 2021 and 2023. We're talking a $90 billion profit to a $23 billion loss, then back to a $96 billion profit.
That's a roller coaster.
It is. And he humorously points out that these figures are calculated according to those pronouncements from esteemed accounting bodies, audited by top-tier professionals, and widely reported in the media, with everyone involved feeling like they've done their job.
So it's all very official.
It is. But he expresses discomfort with this widely accepted metric. He argues that earnings should be something that even Bertie, that typical Berkshire shareholder, can understand and use to evaluate a business.
So it should be clear and meaningful.
Exactly. So he introduces an alternative metric that Berkshire prefers, operating earnings. And he believes this gives a more stable and meaningful picture of their performance.
Okay, what's the difference?
So the main difference between the mandated net earnings figure and Berkshire's preferred operating earnings is the exclusion of unrealized capital gains or losses, which can swing dramatically from day to day and year to year, sometimes exceeding $5 billion in a single day.
So it can be very volatile.
It can. He acknowledges that capital gains are important for Berkshire's long-term value creation.
Yeah.
But he says including their unpredictable swings in those earnings figures distorts the company's true economic performance.
So it's not a true reflection of their operating results.
Exactly. He points out that his personal investment philosophy has always been heavily weighted towards equities, going back to his first stock purchase in 1942. And he expresses this unwavering faith in the long-term potential of American businesses, noting the remarkable growth of the Dow since his early investing days.
So he's a believer in the American economy.
He is. But he cautions against judging Berkshire's investment value based on those short-term stock market fluctuations. He reminds us of Ben Graham's wisdom, that the market is a voting machine in the short run, but a weighing machine in the long run.
That's a classic quote.
It is. And he makes it clear that while he expects capital gains to be a big contributor to Berkshire's value over time, it's misleading to judge their performance based on the market's whims, which can be irrational, especially in the short term.
So focus on the fundamentals, not the noise.
Exactly. Then he moves on to describe Berkshire's core business strategy, which centers around acquiring and owning businesses with strong and enduring economic fundamentals. But he acknowledges that predicting which businesses will thrive and which will fail is tougher than it looks.
It's not an easy game.
It's not. And he cautions against those who claim to have a crystal ball, often driven by self-delusion or a desire to sell you something.
So be wary of the fortune tellers.
Exactly. He reveals that Berkshire especially favors companies that can reinvest their earnings at high rates of return, creating that compounding effect that can generate significant wealth over time.
So it's about finding those compounding machines.
Exactly. He points out that simply owning one exceptional business and holding on to it can lead to extraordinary returns and even provide a lifetime of financial security for the owner and their heirs.
That's a powerful statement.
It is. He adds that while he prefers businesses run by competent and trustworthy managers, judging character is tough. And even Berkshire has had his share of disappointments.
So even he makes mistakes.
He does. And he shares a timeless piece of wisdom from Hugh McCulloch, the first comptroller of the United States. Never deal with a rascal under the impression that you can prevent him from cheating you.
Wise words.
They are. And he acknowledges that he's learned this lesson the hard way, realizing that sincerity and empathy can be easily faked, making it tough to truly judge someone's character.
Trust but verify.
Exactly. He then reflects on Berkshire's acquisition history, noting that in the early days, there were tons of attractive candidates. But as Berkshire has grown, finding suitable acquisitions has become harder.
Makes sense. The bigger you get, the harder it is to find those needle-moving deals.
Exactly. And he says this is partly due to their size, and partly because there's more competition from other buyers. He points out that Berkshire now has the largest GAAP net worth of any American business, over $561 billion at the end of 2023.
Wow, that's a lot of money.
It is. He compares this to the combined net worth of the other 499 companies in the S&P 500, which totaled $8.9 trillion in 2022, and likely won't exceed $9.5 trillion in 2023. And he concludes that Berkshire now makes up nearly 6% of the corporate universe it operates in, which makes it virtually impossible to double their size quickly, especially given their aversion to issuing shares.
So they're kind of a victim of their own success.
In a way, yeah. He acknowledges that only a handful of companies in the United States could truly move the needle at Berkshire, and those have been thoroughly scrutinized by them and others, making it unlikely they'll find any hidden gems.
So the low-hanging fruit has already been picked?
Pretty much. And he admits that the days of finding readily available, attractively priced businesses with exceptional potential are largely gone due to Berkshire's size and the fierce competition for those high-quality assets.
So it's a different game now.
It is. But despite these challenges, he remains optimistic about Berkshire's future, pointing to the quality of their existing businesses and the strength of their management team.
So they're in good hands.
Exactly. And he's happy with their current portfolio, believing it's positioned to do better than the average American corporation, particularly in minimizing the risk of permanent capital loss.
That's a key goal.
It is. He recognizes that while their early years held the potential for those extraordinary returns, their current size limits their upside.
So it's more about steady growth now.
Right. He says slightly better has become a more realistic goal.
Makes sense.
And he emphasizes the consistency and clarity of purpose that have guided Berkshire throughout its history. He restates their commitment to treating employees, communities, and suppliers well, while prioritizing their allegiance to their country and shareholders.
So it's about more than just profits.
Exactly. He reminds us that while Berkshire's money might be combined with that of their shareholders, it ultimately belongs to the owners. And they never forget that responsibility.
That's a good reminder.
Then he talks about those occasional opportunities that pop up when market disruptions cause mispricings in the stocks and bonds of fundamentally sound businesses.
So it's about being ready to pounce when those opportunities arise.
Exactly. And he reminds us that markets can freeze up or even disappear completely, as they did in 1914 and 2001. And he warns against assuming that today's investors are immune to such panics.
So history can repeat itself.
It can. And he argues that the speed of communication and technological advancements have actually made it easier for fear to spread, potentially leading to global paralysis. And he cites the 2008 financial crisis as a recent example of how interconnectedness can amplify and accelerate those market panics.
That's a scary thought.
It is. And he suggests that while these extreme events might be infrequent, they're inevitable. And Berkshire's ability to respond quickly and decisively with substantial capital gives them a unique advantage during these periods.
So they're like the firefighter with a really big hose.
Exactly. He notes that while the stock market has grown massively since Berkshire's early days, human nature hasn't changed. Investors are still susceptible to fear, greed, and irrational behavior.
Basics haven't changed.
Right. And he observes that markets have become increasingly speculative, resembling casinos more than they did in his youth.
Interesting.
And he attributes this shift to the rise of online trading platforms and the ease with which investors can access leverage. And he says it's created an environment where impulsive decisions and short-term thinking are more common.
So it's easier to get caught up in the frenzy.
Exactly. And he criticizes Wall Street's focus on frenetic activity over long-term value creation, suggesting that this emphasis on generating fees and commissions often leads to the promotion of foolish and risky investments.
It's not always in the best interest of the investor.
Right. And he warns about the potential consequences of unchecked speculation, pointing out that when markets inevitably correct, those who've been reckless are often left bewildered and broke.
So it's a cautionary tale.
It is. And he adds that sadly, those responsible for the financial shenanigans often escape unscathed.
So there's a lack of accountability.
Yeah, it's a sobering reminder that market cycles are inevitable, and those who chase quick riches often end up paying the price.
It's about playing the long game.
Exactly. He concludes this section by emphasizing that Berkshire's investment philosophy remains grounded in avoiding permanent capital loss He recognizes that the American economy has historically rewarded those who make a few good decisions and avoid major blunders.
So it's about minimizing mistakes.
Right. And then he reiterates Berkshire's commitment to financial conservatism. He argues that their ability to withstand even the most severe financial disasters is a core strength. They'll never give up.
So they're prepared for the worst.
They are. And he asserts that during economic downturns, Berkshire aims to be a stabilizing force, providing capital and support when others are pulling back. He gives the example of their actions, though on a smaller scale, during the 2008-2009 crisis.
So they're a source of strength in times of trouble.
Exactly. And he explains that they achieved this resilience through a diversified earnings stream, minimal cash requirements, and disciplined capital allocation. He emphasizes that they don't pay dividends. Their share repurchases are completely discretionary. Their debt maturities are manageable, and they maintain a large cash and U.S. Treasury bill position, far exceeding what conventional wisdom dictates.
So they're very conservative.
They are. And he frames this extreme caution as a promise to Berkshire shareholders, recognizing that while it might seem unnecessary in most years, it provides peace of mind and protection against those catastrophic events. He compares this approach to an insurance policy. On a seemingly fireproof building, it might seem redundant, but it provides invaluable protection against unforeseen circumstances.
It's the analogy.
Buffett concludes this section by stating that Berkshire is built to last. He highlights their ability to withstand shocks and endure over the long term, regardless of the economic climate.
It's a fortress.
Pretty much. Then he turns his attention to some of Berkshire's non-controlled businesses, starting with Coca-Cola and American Express. And these long-term holdings each represent about 4 or 5% of their GAAP net worth.
So not insignificant.
Not at all. He acknowledges that these aren't massive positions, like their Apple investment, but they are significant and illustrate Berkshire's investment approach beautifully.
Okay, how so?
Well, he highlights the longevity of both companies, noting that American Express was founded in 1850 and Coca-Cola in 1886, underscoring his preference for businesses with proven track records.
So they've stood the test of time.
They have. And he points out that both companies have tried expanding into unrelated areas with limited success, suggesting their strengths lie in their core businesses, which they've refined and adapted over time.
So stick to your knitting.
Exactly. Buffett emphasizes the global reach and enduring appeal of both Coke and Amex. They become iconic brands, recognized worldwide, and their products address those fundamental human needs, drinking, and the need for trustworthy financial services.
So they have a wide moat.
They do. He reveals that Berkshire didn't buy or sell any shares of either company in 2023, continuing their Rip Van Winkle slumber. That has spanned over 2 decades.
So they're just letting them do their thing.
Exactly. And he expresses satisfaction with this patient approach, noting that both Coke and Amex rewarded their inaction by increasing earnings and dividends. Amex's 2023 earnings even surpassed Berkshire's initial investment costs from years ago.
And that's the power of compounding.
It is. And he predicts that both companies will probably raise their dividends again in 2024, further boosting Berkshire's returns.
Nice.
He expresses complete confidence in the long-term prospects of both businesses, even questioning whether he could create a better global enterprise than either Coke or Amex.
High praise.
It is. And he imagines his sister Bertie would readily agree with him.
Of course.
Then he points out that while they didn't directly buy shares of either company in 2023, their indirect ownership grew thanks to Berkshire's own share repurchases. And he explains that buybacks effectively increase shareholders' proportional ownership of all Berkshire's assets, including those holdings in Coke and Amex.
So it's a way to concentrate their ownership.
Exactly. But he adds his usual caveat that share repurchases should only be done when the price is right, ideally at a discount to the underlying business value, because buying back stock at a premium destroys value instead of creating it.
Makes sense.
And he boils down the key lesson from Coke and Amex into this simple message. When you find a truly exceptional business, hold on to it patiently, because the compounding effect of reinvesting earnings and increasing dividends can generate remarkable wealth over time.
Patience is key.
It is. And he suggests that one wonderful business can more than compensate for the inevitable mediocre investment decisions that even the most skilled investors make.
So it's about finding those winners.
Exactly.
Oh.
Next, he introduces 2 other investments that Berkshire plans to hold indefinitely: Occidental Petroleum and a basket of 5 large Japanese companies. He acknowledges that these holdings aren't as big as their Apple position, but are still meaningful and worth discussing.
Sounds interesting.
So at the end of 2023, Berkshire owned 27.8% of Occidental's common shares and held warrants that let them increase their stake at a fixed price for several years.
Well, they have some flexibility.
They do. But he emphasizes that while they appreciate their ownership and the flexibility the warrants provide, they have no interest in taking control of Occidental or actively managing its operations.
So they're happy to be passive investors.
Exactly. And then he highlights two things they particularly like about the Occidental: its vast oil and gas reserves in the United States and its leadership in carbon capture initiatives, although he acknowledges the economic viability of carbon capture is still uncertain.
So it's a bit of a bet on the future.
It is. And then he talks about how important domestic oil production is for the United States, contrasting the country's current energy independence with its past reliance on foreign oil. He recalls a time when the U.S. heavily depended on those potentially unstable overseas suppliers, with domestic oil production falling far short of the country's needs.
So it was a vulnerable position.
It was, and this vulnerability led to the creation of the Strategic Petroleum Reserve, SPR, in 1975, which was meant to act as a buffer against those oil supply disruptions.
A safety net.
Exactly. But then the shale revolution, which kicked off around 2011, transformed the U.S. energy landscape, turning the country into a net exporter of oil and reducing its dependence on OPEC.
So a major shift.
It was. And he emphasizes the crucial role that Occidental has played in this transformation with its annual U.S. oil production, rivaling the entire SPR inventory. He even suggests that without the shale boom, the U.S. would be in a tough spot today, facing those serious energy shortages and economic disruption if foreign oil supplies were cut off.
This is a matter of national security.
In a way, yeah. Buffett praises Occidental CEO, Vicki Hollub, for her leadership and expertise in oil extraction, acknowledging that while oil prices are inherently unpredictable, her ability to efficiently extract oil from those shale formations is a valuable asset to both shareholders and the country.
So she's a real asset.
She is. Switching gears to Japan, Buffett describes Berkshire's passive long-term investment in 5 big Japanese trading companies: Ippochu, Marubeni, Mitsubishi, and Sumitomo.
Okay.
And he explains that these companies operate in a diversified way, much like Berkshire, with interests across a wide range of industries.
So they're kind of like mini Berkshires.
In a way, yeah. He reveals that they increased their stakes in all 5 companies in 2023, following a trip to Tokyo with Greg Abel, his chosen successor as CEO, where they met with the managements of these companies.
So they did their due diligence.
They did. And by year-end 2023, Berkshire owned roughly 9% of each of the 5 Japanese companies, with a commitment not to go over 9.9% ownership. Their total investment was $1.6 trillion, and the year-end market value was $2.9 trillion, a 61% unrealized gain in dollars, even with the yen's recent weakness.
That's a nice return.
It is, and he acknowledges that he and Abel don't try to predict currency movements, preferring to hedge their exposure by financing these investments, mainly with yen-denominated bonds.
So they're mitigating that currency risk?
Exactly. He notes that Berkshire has issued more yen-denominated debt than any other American company, reflecting their confidence in the Japanese market. And he says the weaker yen has generated a $1.9 billion gain for them, recognized on their income statement over the past few years, as per GAAP rules.
Okay.
And then he highlights some shareholder-friendly policies that these Japanese companies practice, which he believes are superior to common practices in the U.S.
Oh, interesting. What are those things?
So he points out that since Berkshire started investing in these companies, they've all reduced outstanding shares through buybacks at attractive prices, boosting shareholder value. And he praises their relatively modest executive compensation compared to the often excessive pay packages in the U.S.
So they're more aligned with shareholders?
They are. He observes that these companies, like Berkshire, prefer to keep a good portion of their earnings, usually paying out about 1/3 in dividends, and they reinvest the rest in their businesses and share repurchases, prioritizing long-term growth and shareholder value over those short-term payouts.
It's a long-term focus.
It is. Buffett also sees potential for future partnerships with these Japanese companies, leveraging their global reach and diverse expertise. And he highlights Berkshire's financial strength and willingness to provide capital for such ventures, offering reassurance to their Japanese partners.
So it's a win-win.
Exactly. He concludes this section by recognizing the challenges of building big positions in publicly traded companies through open market purchases, especially given Berkshire's size. He compares it to turning a battleship It takes patience and a prolonged period of attractive prices, which is a disadvantage they didn't face in their earlier days.
It's a different game now.
It is. Then he transitions to discussing Berkshire's performance in 2023, providing a condensed income statement that shows the contributions of their different business segments.
Okay.
And he notes that at the annual meeting in May 2023, he had predicted that most of their non-insurance businesses would see lower earnings in the coming year, while their insurance operations were likely to perform well. And he had expected the decline to be somewhat offset by decent results from BNSF, their railroad business, and Berkshire Hathaway Energy, BHE, their utility and energy subsidiary, which together accounted for over 30% of their 2022 operating earnings. He also predicted that their investment income would increase substantially due to rising interest rates, which would boost returns on their large U.S. Treasury bill holdings.
So he had a pretty good sense of where things were headed.
He did. Looking back, his assessment of the insurance business was spot on. It had record-breaking results. However, he admits he misjudged the outlook for both BNSF and BHE, which faced bigger challenges than he'd anticipated.
So even he gets it wrong sometimes.
He does. And he delves into the specifics of BNSF's performance, emphasizing the essential role that railroads play in the U.S. economy and their capital-intensive nature. He points out that rail is the most efficient way to move heavy goods over long distances, making it crucial for the country's economic future.
So it's a vital industry.
It is. He acknowledges that BNSF's profitability might look good on the surface, but he cautions that their hefty capital expenditures, which consistently exceed their depreciation charges, hide the true economics of the business.
Okay, so it's not as profitable as it seems.
Exactly. He explains that these ongoing investments, totaling $22 billion over the past 14 years, are necessary to maintain BNSF's vast network of tracks, tunnels, bridges, locomotives, and other infrastructure.
So it's a lot of upkeep.
It is. He estimates it would cost at least $500 billion and take decades to replicate BNSF's assets today, highlighting the immense scale and complexity of their operations.
That's mind-boggling.
It is. And he points out that this high level of capital intensity means dividends paid to Berkshire from BNSF will always be less than the railroad's reported earnings, unless they take on more debt, which they're not willing to do.
Okay.
So he acknowledges that while Berkshire is earning an acceptable return on their initial BNSF investment, the returns on the replacement value of those assets are slim. And he explains that this wasn't a surprise to them, as it's what allowed them to buy BNSF for a fraction of its replacement cost back in 2010.
So they got a good deal.
They did. Then he dives into some of the inherent challenges of the railroad industry, highlighting the complexities of managing a massive network spanning thousands of miles and facing diverse operating conditions.
It's a logistical nightmare.
It can be. He notes the revenue imbalances that can come from one-way hauls, the impact of extreme weather, and the difficulty of predicting and mitigating the risks of transporting hazardous materials.
So a lot of moving parts.
There are. He also touches on the changing labor market, observing that fewer Americans are willing to take on the demanding and often solitary jobs vital to railroad operations.
Yeah, it's not an easy job.
It's not. He even shares a poignant example of the emotional toll this work can take, describing the tragic reality of engineers who are sometimes forced to witness suicides on the tracks, which is a disturbingly frequent occurrence in North America.
That's heartbreaking.
It is. Then he gets into the challenges BNSF faced in 2023, noting that earnings declined more than he'd expected due to lower revenues and rising costs, especially labor costs, driven up by federally mandated wage increases, exceeding inflation.
So they were squeezed from both sides.
They were. He acknowledges that BNSF's profit margins have trailed their peers since Berkshire bought the company, despite hauling more freight and investing more in capital expenditures.
So they're not as efficient as they could be.
Right. However, he expresses confidence that BNSF's expansive service territory and operational improvements will eventually lead to margin expansion.
So they're optimistic about the future.
They are. He ends his discussion of BNSF by reiterating his pride in the company's contribution to the country and praising the dedication of its employees, who often work in tough conditions to keep America's supply chains moving. And he expresses this unwavering belief that BNSF will remain a valuable asset to both the nation and Berkshire for generations to come.
It's a long-term view.
It is. Next, he shifts his focus to Berkshire Hathaway Energy, BHE, their utility and energy subsidiary, and he reveals it was their biggest earnings disappointment in 2023. He explains that while most of BHE's electric utility businesses and gas pipelines performed as expected, regulatory hurdles in a few states cause significant headwinds, raising concerns about future profitability and even the potential for bankruptcy.
So some serious challenges.
Yeah. He cites Pacific Gas and Electric, California's largest utility, which was forced into bankruptcy,
Yeah.
and Hawaiian Electric, currently facing similar threats, as examples of the risks posed by this increasingly hostile regulatory environment.
So it's a trend.
It seems so. He explains that for decades, electric utilities relied on a regulatory model that guaranteed them a fixed return on equity, allowing them to raise capital and invest in infrastructure with confidence.
Okay.
And he says this model encouraged long-term planning and ensured utilities could meet future demand, even if population growth or industrial activity surpassed expectations. And he points to BHE's massive multi-state transmission project in the western U.S. started in 2006 and still years from completion, as an example of the kind of forward-looking investments that this model facilitated.
So it incentivized those long-term investments.
Exactly. However, he observes that this long-standing agreement between regulators, investors, and the public has broken down in some states, leaving investors wary of similar disruptions elsewhere.
So it's a loss of trust.
In a way, yeah. And he notes that climate change is adding further complexity, as utilities are increasingly expected to invest in those costly upgrades in infrastructure to address risks from extreme weather and the transition to renewable energy.
So it's a moving target.
It is. And he cites the example of underground transmission lines, which can help prevent wildfires, but are much more expensive to install than those traditional overhead lines.
Right, so it's a trade-off.
Exactly. He then discusses the challenges BHE has faced with wildfires, acknowledging their increased frequency and intensity, likely due to climate change.
It's a growing problem.
It is. And he reveals they've made a preliminary estimate of losses from these wildfires. But it will be years before the final tally is known, and they can make those informed decisions about future investments in vulnerable areas.
So it's a waiting game.
It is. He expresses uncertainty about whether this regulatory environment will spread to other states, potentially creating more headwinds for BHE and other utilities.
So it's a risk to watch.
Definitely. He acknowledges that a confiscatory outcome to their current regulatory issues would be a setback for BHE, but he emphasizes that both the company and Berkshire are financially strong enough to handle negative surprises. He draws a parallel to their insurance business, where risk assumption is their core competency.
So they're used to dealing with the unexpected.
They are. And he reiterates that Berkshire's philosophy is to avoid throwing good money after bad, suggesting that if the regulatory environment stays unfavorable, they'll be cautious about further investments. In certain regions, he suggests that the ultimate outcome of this regulatory shift could be a move toward a public power model for the utility industry, as some states might become hesitant to give private companies the returns they need to justify the risks. And he cites Nebraska, which adopted a public power model in the 1930s as an example, noting that many other public power operations exist across the country.
Okay.
So he concludes that the decision of whether to embrace a private or public model will ultimately be up to voters, taxpayers, and consumers, who will weigh the costs and benefits of each approach.
It's a complex issue.
It is. He admits that he didn't foresee the negative developments in regulatory returns, acknowledging that he and Berkshire's partners at BHE made a costly mistake by underestimating the risks posed by this changing landscape.
So they learned a lesson.
They did. Then he shifts gears to highlight the positive performance of Berkshire's insurance business in 2023, noting that it achieved record sales, float, and underwriting profits, solidifying its position as a key driver of the company's success.
So a bright spot.
Definitely. He emphasizes that after 57 years in the insurance business, and despite an incredible 5,000-fold increase in volume, they still see substantial room for growth.
That's impressive.
It is. And he reflects on the lessons they've learned, often through those tough experiences, about which types of insurance businesses and people to avoid, stressing the importance of underwriting discipline and healthy skepticism towards optimistic projections.
So it's about being realistic.
Exactly. He reiterates that surprises in the property casualty insurance business are almost always negative, as unforeseen events and rising claims costs can pop up years or even decades after policies are written.
So it's a long-tail risk.
It is. He acknowledges that while industry accounting standards try to account for this uncertainty, estimation errors can be significant. And when fraud or recklessness is involved, the consequences can be severe.
So it's a risky business.
It can be. Buffett emphasizes that Berkshire strives for accuracy in its loss reserving practices, but recognizes that inflation, both monetary and legal, can throw a wrench in even the most prudent estimates.
So it's a constant challenge.
It is. He then praises Ajit Jain, the longtime leader of Berkshire's insurance operations, crediting him with transforming the business. Since joining in 1986, he recalls his own struggles to build a successful insurance operation before Jain arrived, highlighting the remarkable turnaround that Jain orchestrated.
So he's a key player.
He is. Buffett praises the depth and talent of Berkshire's insurance management team, comparing them to baseball's Hall of Famers.
High praise.
It is. And he assures Bertie, his representative shareholder, that she can feel confident owning a piece of an exceptional insurance operation with unparalleled financial strength, reputation, and expertise. And he notes that this business carried the day for Berkshire in 2023.
So they're in good shape.
They are. Then he lightheartedly ponders this seemingly disproportionate concentration of talent that has emerged from Omaha, Nebraska, Berkshire's headquarters.
There's Omaha effect.
Exactly. And he invites shareholders to consider the backgrounds of the three key executives who will be on stage at the upcoming annual meeting: Greg Abel, Ajit Jain, and himself. So he points out that Abel, his designated successor, was born and raised in Canada and only lived in Omaha briefly in the 1990s, a period when they never even met.
Okay.
Jain, who heads their insurance operations, was born, raised, and educated in India, living in Omaha for a few years with his family decades ago. But he's maintained close ties to the city. Despite moving to New York for work,
Okay.
Buffett notes that while he and Munger were both born and raised in Omaha, their paths didn't cross until much later in life. He even throws in a historical tidbit, pointing out that Munger, due to his long life, lived under 15 of America's 45 presidents.
Wow.
Then he highlights Berkshire's relocation to Omaha in 1970, after spending its first 81 years in New England, suggesting the move was beneficial.
So Omaha was a good move.
It seems so. Then he brings his sister, Bertie, back into the story, revealing that she, too, spent her formative years in Omaha before becoming a highly successful investor. And he clarifies that Bertie's success wasn't simply from investing in Berkshire and holding her shares. She actively managed her portfolio for years, investing in bonds, mutual funds, and individual stocks.
Okay.
But at 46, she simplified her approach, keeping only her Berkshire shares and mutual fund holdings, making no further trades for the next 43 years.
Wow, that's a long time.
It is. And this patient, long-term strategy, combined with her astute choice of Berkshire, allowed her to amass significant wealth, even after making those substantial charitable donations.
So it's a testament to her wisdom.
It is. And Buffett suggests that millions of other American investors could have achieved similar results by following her common-sense approach, which he attributes, perhaps jokingly, to her upbringing in Omaha.
The Omaha effect again.
Exactly. And he playfully asks if there's something in Omaha's water, air, or maybe a unique planetary alignment that's fostered such a concentration of talent.
Maybe there's something in the corn.
Maybe. He invites shareholders to join them in Omaha for the annual meeting, encouraging them to experience the city and draw their own conclusions. He promises a good time, a friendly atmosphere, and a chance to meet Bertie and her daughters, even hinting at the possibility of unlocking the secret to their investment success.
Sounds like a fun trip.
He concludes by promoting the new edition of Poor Charlie's Almanac, a collection of wisdom from his late partner, suggesting it can offer valuable insights and improve readers' lives.
Good read.
He wraps up his letter with a table comparing Berkshire's annual performance to that of the S&P 500 index, highlighting their long-term outperformance.
Okay.
The table shows that from 1965 to 2023, Berkshire's per-share market value compounded at an annual rate of 19.8%, compared to 10.2% for the S&P 500, including dividends. This translates into an overall gain of 4,384,748% for Berkshire versus 31,223% for the index. It's a powerful demonstration of their consistent and substantial outperformance over nearly 6 decades.
It's an incredible track record.
It is. And with that, Buffett concludes his 2023 letter to shareholders, leaving us with a wealth of insights into his investment philosophy, his thoughts on the current economic landscape, and his enduring belief in the long-term prospects of Berkshire Hathaway.
It's a lot to chew on.
Definitely. Well, I think we've covered a lot of ground today, from Buffett's early days in the investment world to his latest thoughts on the market and the economy.
It's been a fascinating journey.
It has. And I think there's some really valuable lessons here for anyone who wants to be a better investor or just a better business person in general.
Absolutely.
So I encourage you to go back and read Buffett's letters and really think about the principles he lays out, because they're timeless and they can help you achieve success no matter what your goals are.
Wise words.
And if you enjoyed this deep dive into Warren Buffett's wisdom, be sure to hit that subscribe button for more invaluable financial and business insights delivered right to you. Until next time.
Happy investing.